Hello and welcome to Do Na Tien Investment. This analysis is for AppLovin on Nasdaq as of 7th of August 2026 with a share price of $335. The full report is on donatien.ca, UK, a hold across all three horizons at $335.67. AppLovin's first guidance midpoint miss since its 2021 IPO knocked the stock about 20% and derated it out of the expensive band into full, clearing the valuation gate but leaving an elite business at a fair, not cheap price on a broken tape. No entry path is open. This is a hold and watch, not a buy the crash and not a do not buy. AppLovin remains one of the most profitable software businesses at its size, operating margins of about 78%, roughly $4.5 billion of free cash flow, and a Rule of 40 score near 119, off the charts. Second quarter revenue grew 52.8% year-on-year to $1.924 billion. But it missed the roughly $1.95 billion consensus and the company's own guidance midpoints, the first such miss since the 2021 IPO, and sequential growth cooled to about 4.4%. Management put it down to the timing of ad model improvements as it pushes Axon into e-commerce. The business is elite. The durability of the hypergrowth is, for the first time, a live question. Quality scores 81. The D rating is the story of this report. The roughly 20% print reaction dropped the clean trailing price to earnings from the expensive band down to about 25.8 times, against a warranted multiple of 20.5 times, anchored to the 10-year yield and a haircut growth rate that is 1.26 times, which lands the name squarely in the full band and below the 33 times sector guardrail. So the valuation ceiling gate that fired last quarter now clears. On forward earnings, it looks cheaper still, about 15.8 times, with a peg near 0.7, but that only pays off if the recovery lands. The read, fair, not cheap. The crash removed the overvaluation problem without turning this into a value buy. Valuation scores 47. The chart is broken but deeply oversold. AppLovin made a fresh 52-week low on the report session, with the daily relative strength index at 28.9, washed out, but with no confirmed reversal, no higher low, and price far below its moving averages. On the framework, 0 of 3 entry paths are open, so entry conviction reads, wait, timing scores just 35. That is why, even with the valuation gate cleared, all three horizons stay hold. The long-term anchor caps a full band name at fair, so there is no buy to be had, and the short-term tape gives no reason to step in front of a falling knife the day after the first guidance miss since the IPO. The risks carry at least equal weight to the quality. First, growth deceleration is now real. The e-commerce push, the largest part of the bull case, is exactly what under-delivered, and expanding beyond gaming is proving harder than assumed. Second, even after the crash, the name is not cheap. At 1.26 times the warranted multiple, the price already embeds a recovery, so a second weak quarter would hurt. Third, AppLovin is contested in e-commerce by Meta, Google, and the Trade Desk, all with deeper first-party data. And fourth, the inherited AI cohort derating tail still hangs over the whole group, a compression from about 26 times toward 18 times, though much of that has already happened, with the stock down 45% from its May high. Against all that, elite margins, roughly $4.5 billion of free cash flow, and the cheapest forward multiple in its history cushion the downside, which is why this is a hold, not a sell. The bear case is $270, about 20% below the price. Now weigh the risk against the reward. The bull case is roughly 49% above today, the base case the most likely about 22%, and the bear case a fall of about 20%, so you are risking about 20 to make 49. So, our call on AppLovin, on Nasdaq, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Do Na Tien Investment at donatien.ca. The link to the full report is in the notes below. Have a great day.